Welcome back to our channel Accountancy. Our today's video is about the accounting cycle. What is the accounting cycle? The accounting cycle refers to the sequence of accounting procedures used to record, classify, and summarize business transactions. Accounting cycle is the systematic recording of the accounting transactions. This systematic recording consists of some steps which are adopted by every business unit throughout its life to maintain business records. Now look at this picture. This pie chart shows the accounting cycle of a business unit. This cycle starts with the identification of transaction and ends with the reverse entries. Now we shall discuss these steps one by one. And the first step is the identification of transaction. Identification of transaction. A transaction is an event that can be expressed in terms of money and brings changes in the financial position of a business unit. There are different types of transactions. A transaction may be an external transaction, that is, a transaction between a business unit and an outsider, for example, supplier or customer, etc. Goods purchased or sold to an outsider is known as an external transaction. An internal transaction is a transaction which does not involve an outsider. For example, depreciation charged on plant and machinery, etc. A credit transaction is a transaction where goods are purchased or sold on credit instead of paying or receiving cash immediately at the time when the transaction took place. And a cash transaction is a transaction where goods are purchased or sold for cash. So, in accounting cycle, the first step is to identify the nature of the transaction, whether it is an external or internal transaction, or it's a credit or a cash transaction. After the identification of the transaction, the next step in accounting cycle is to obtain source document. Source documents. The documents on which a business transaction is recorded are called source documents. Source documents include sales order, purchase order, invoices, credit notes, vouchers, credit card sales voucher. So whenever business transaction takes place involving sales or purchases, receiving or paying money, owing or being owed money, etc., it is usual for the transaction to be recorded on a document. And these documents are the source of all the information recorded by a business unit. After preparing or obtaining source documents, the next step is to record the information in the books of original entry. Books of original entry. Books of original entry or books of prime entry or journals are used to record different types of transactions for the first time. Books of original or prime entry includes sales day book, purchase day book, sales return day book, purchase return day book, cash book, journal proper. Books of prime entries are used to summarize a large number of similar transactions, for example, credit sales, credit purchases, cash receipts and payments, revenues and expenses, etc. After recording journal entries, the next step is posting these entries into the ledger accounts. Ledger accounts. A ledger is a book or collection of accounts in which account transactions are recorded. Each account has an opening or carried forward balance. First, we have to understand what is an account. In bookkeeping process, all the transactions are categorized into different types and then they are recorded in the series of individual records called accounts. There are separate accounts for each type of transaction. An accounting ledger may include accounts like cash, account receivable, investments, inventory, account payable, accrued expenses, and customer deposit, etc. T accounts. Ledger accounts are also known as T accounts. T accounts are divided into two sides. The left hand side represents the debit side and the right hand side represents the credit side. After posting the information into the ledger account, the next step is to prepare trial balance. Trial balance. Trial balance is the list of balances which are extracted from general ledger. It is the comparison of total debits and credits of the various accounts. The trial balance is prepared to ensure that all debit balances of the accounts are exactly equal to the credit balances of all the accounts. So, the proof of the equality of the debits and credit balances is called trial balance. There are some transactions which may occur after the preparation of trial balance, so we have to pass adjusting entries for such transactions. So, passing adjusting entries is our next step. Adjusting entries. Before preparing final accounts, some items like expenses and revenues require adjustment. For example, outstanding or prepaid expenses, unearned or accrued revenues, etc. Entries to record these adjustments are known as adjusting entries. After preparing trial balance and adjusting entries, the next working level in accounting is to prepare final accounts. Final accounts. Final accounts are prepared to evaluate the overall financial position of a business unit. Financial accounts includes a statement of financial position, a statement of comprehensive income, a statement of changes in equity, a statement of cash flows, notes to the financial statements. These financial statements are prepared in accordance with the approved accounting standards which are applicable in the particular state. The major accounting standard bodies are International Financial Reporting Standards, International Accounting Standard Boards, Islamic Financial Accounting Standards, etc. These accounting standards are used in all over the world to maintain final accounts. And the next step is to pass closing entries. Closing entries. At the end of every accounting period, revenues and expenses accounts are closed by transferring their balances to trading profit and loss account. The purpose of closing entries is to transfer the net profit or loss for the period to retained earning and to zero out all the temporary accounts. Modern accounting software automatically generates closing entry. And the last step in accounting cycle is reverse entries. Reverse entries. At the beginning of each accounting period, some accountants use reversing entries to cancel out the adjusting entries that were made to accrued revenues and expenses at the end of the previous accounting period. Reversing entries make it easier to record subsequent transactions by eliminating the need of certain compound entries. Remember that these entries are optional provided there are some adjustment entries that need to be reversed. And that's all for today. Thank you for watching. Stay blessed.